Marlon. My name is Jack Stoch. I am the president of Globex Mining Enterprises, Inc. We are a property bank, exploration company, and royalty company listed on the Toronto Stock Exchange. We have a different kind of business model, which you'll see as we go forward in this interview.
Jack, thank you very much for the introduction. What a pleasure to meet you. I see that the company's been around for a long time. Can you just tell me when did you become the CEO?
I became the CEO in 1987, 1 month after the crash. That was when we listed on what was then the Montreal Stock Exchange, and eventually we went to the Toronto Stock Exchange, where we are.
I think that must be a record. 1987. That's absolutely fantastic. So you've been at the helm. You've got an extraordinary portfolio of projects. You've got, looking at your presentation, you've got 221 projects, which includes 221 properties, which includes 89 royalties, and that's built up over that time. Before we get onto that portfolio, can we just cast our mind back to 1987 and the kind of the ups and the downs? It must have been an extraordinary series of cycles that you've lived through. Any commentary on the cycles?
Yeah, when we started off in 87 with one property, which we still have, by the way, and we've made a copper zinc discovery on. But it's been quite a challenge. This business is a business of ups and downs. Most of the things are outside of our control. We're talking about the economy, you're talking about metal prices, you're talking about politics. What we try to do is work with a business model that limits the negative effects of those types of cycles. And we can't really eliminate them completely, but the best I'd say is we moderate them. So and we do that through our diversity, through the fact that we make sure that we have no debt, through the fact that we make sure that we have money in the bank and that we have revenue and we own our assets. So it gives us a much more stable outlook and ability over time, which most other junior mining companies don't have.
Where's your sweet spot in the kind of the property kind of development chain? Do you stake ground?
Yeah.
Typically.
Yeah, our specialty is acquisition. We acquire things that we think have value when other people aren't focused on it. For example, 2 months ago, for under $1,000, we acquired 24 million ton open pittable dolomite deposit. Dolomite is used in the steel industry and a number of other industries. This particular property, the metallurgy is done. There's 24 million tons outlined already. It is on basically the southern boundary of the property is the St. Lawrence River, and it's within walking distance of the loading docks at Havre Saint-Pierre in Quebec. So it's a good jurisdiction, excellent position, and something where other people have spent tons of money on and eventually over time came open. And we jump on those kinds of things. So we have a lot of properties that other people weren't interested in. And now, for example, gold. There was a big period of time when nobody was interested in gold. We have, in between the royalties and the properties, we have up to 110 gold projects. And we were able to build that up because we acquired them when other people weren't interested in them.
And how do you maintain them? Do you just, and what do you do with them? Do you just put everything on care and maintenance and then incrementally advance them to towards the route to production and then sell them on again? Do you sell a royalty? Do you have to wait for the commodity price to come around?
Well, the answer to what your question is yes and no. We acquire the asset, and the reason we only acquire assets that we think that have value. We're not interested in grassroots assets. So there's usually previous work on the properties. They're in established mining camps. They have, I think 40 of them have former mines on them. 55 of them have historical resources on them. So we acquire the assets. We do work to upgrade them So the initial phase is basically just compiling the information. Then we'll fly, for example, airborne electromagnetic surveys or go in and do geology sampling and so on. Some of the projects are for more quick action to put them on the market. Other ones are more long term. Because for example, when we acquired gold properties, people weren't interested in gold. So we just kept working. And the idea is to increase the value of the asset through the input that we have, which is either intellectual or physical on the ground. So then what we do is we option out, in most cases, we option out the properties when people are interested in that commodity. And the typical deal that we do is a 4-year deal. Each year, the company that is optioning the property from us pays us cash, gives us shares in their corporation, and agrees to do a minimum amount of work. So you're going to end up over the 4 years with millions of dollars of work input, often millions of dollars of cash and shares payable to us if they go to the end. And if they go to the end, we end up with something called a gross metal royalty, which is something that we invented. You're probably familiar with net smelter royalties and net profit interests. Basically, if you do those, you're going to end up dealing with lawyers, because people being what they are, when there's money on the table, they get stupid. So what we do is we created this gross metal royalty, which is the percentage of the metal paid by the refinery or smelter directly to us upon the production of the metal. So for example, if we have a 3% gross metal royalty and the property goes into production, the refinery will be paying us 3% of the gold produced. Nothing to fight about. It's paid by the third party. They are given the instruction at the very beginning by the optioning party, and no lawyers involved, no dealing with fancy audits and so on. It's all independent, and we don't fight, and the lawyers don't make a living off of us. So it's a different kind of model.
I had a look on your website, and I think the most recent financial report is the quarter, which gives the numbers up to the end of September.
We actually just submitted the annual.
Ah, damn it! I've missed it.
2 days ago.
Oh, okay. I saw a PDF file on the 23 section, but anyway, I clicked on it, didn't open up. But anyway, I should have gone on to CEDAR. But the September numbers, and they're obviously a quarter out of date, but I hope they'll be illustrative. They showed you had $10 million in cash and or $11 million in cash, 10.9 in cash, and $10 million in investments. And is that a reflection of the shares payment and the cash payment?
Yeah, actually, the numbers currently, the total is about 25 million, 10 and 15, and that would include some of the property assets. We own a number of buildings. We own our offices. Like this office in Toronto is a corporate condo. We own it. We own 2 office buildings up in Rouyn-Noranda where all our staff are, and so on. So basically, if you put the whole total thing together, it's about 30 million, but 25 million in cash and shares. And then we have a deal with Yamana, which actually Yamana just got taken out today by Pan American Silver and Agnico Eagle. But they have to pay us over the next 3 years another $8 million. So we have our cash, we have our shares, we have the ongoing payments guaranteed by, I guess now, Pan American and Agnico Eagle. Plus, we have 9 other options which are generating income through the option process, which I just described a short while ago.
I guess that what we're skirting around is trying to work out how to value your company. I mean, you've got a market capitalization of $41 million Canadian, and I can see that you went for this. Your value must have jumped hugely in 2007 or 2006, and and then, like most other resource companies, gave a lot of that back. It's up and down. And when I look at your presentation, I flick through the properties, and when you've only got a small brain, it's quite overwhelming to kind of work out how how to value your company, and in a sense, you recognise that. I think you on slide 3 of your presentation, you write focus on the value.
Right. Yeah. It's very hard to understand what we do because there is no other company, I think, really exactly like us that views the final product as money rather than the mineral, and that has such a low risk ratio compared to what other companies are doing. Because we try not to dilute our shareholders. We only have 55.1 million shares outstanding, and we buy back shares. I mean, like if you looked at the number of shares that on the quarterly, it showed, I think, 55.6 million shares. Well, recently we just bought back another 450,000 shares. So we're, diminishing the market. We don't have much stock out anyway, but we're trying to, it's a great deal at the price it is. So we're happy to buy it back, while at the same time not interfering with other people, accumulating. If they wish to take the chance of investing. But it's the model is different because of the number of assets, the diversity of the assets, and it's hard for you to value it, considering also the amount of cash we have. And we own all of those 221 assets. We own them. We don't owe any money to anybody. We don't even pay rent on our buildings. We own our buildings. We own our vehicles. We own our geophysical equipment. We own everything. I don't believe in debt, which is a bit weird but the good thing is when the markets turn, and they always turn, as you indicated previously, the ups and the downs, we don't suffer like the other ones. We don't have to move to the basement of our house. Like, we continue along because we have money, we have assets, we have no debt.
Do you feel as if we're not in a downturn at the moment? Do you feel as if things are good? Because if you speak to most of the rest of the junior sector that don't have money, they would say that times are tough at the moment.
It depends on your business model. I mean, in what's a lousy market for other people is a great market for us because we can acquire assets cheaply. When it's a good market for them, they've got money and they need assets. So we're perpetually, I don't want to say in a good place, but we're in a better place than most others.
Yeah, interesting. Just on the, I've got so many questions, but your shareholder register, please. You say that you've got a good shareholder register. Can you describe that to me, and how's that evolved over time?
In the sense of who owns it, or the number of shares?
Yeah, who owns it?
Who owns it? It's all individual shareholders. We don't have a brokerage following per se. We have individual brokers who like us, who buy it for themselves and for some of their clients. But the reality is we don't have a brokerage following. Like, we've never been recommended, for example, by any brokerage firms. And that would be because we never do finance. Well, never, but we don't do financings. We make money because we make money. They don't make fees. If they don't make fees, we don't exist. Just as that simple.
Yeah, absolutely, crystal clear. If you don't issue stock and pay fees, why would they give you the time of day?
Because we're a great company, we have great assets, we make money, and we're the lower risk profile than most of their other people that they give money to.
Yeah, no, but sadly, it doesn't necessarily work like that.
I know. Yep.
But do you have any institutional shareholders, and what do you and the family own of the company?
Between myself and my wife, we own just over 10% of the company, but almost 11%. And the Quebec government fund owns. Other than that, that's it.
Is there are they a disclosable reportable amount, or is it just that you good, really interesting. When it comes to valuation, do you do peer analysis with yourself and other royalty companies, not other royalty companies, but with royalty companies?
No, because we don't have a peer. That's the problem. Is that nobody has the complete model that we have. There are royalty companies, we do royalties. There are exploration companies, we do explorations. There are companies that are whose business is to acquire properties and then option them out. We do that, but there's nobody else except maybe Riverside, I think, that which focuses on Mexico and South America. I don't think there's anybody else that does what we do. No peers.
what do you think the share price should be? How would you value it?
Well, you're obviously asking somebody who has a particular interest. But let me just say, in 2006, we had very little money. We had, I can't remember the number of properties, maybe 100. And a high-tech group, some guys who made a lot of money in the high-tech business, wanted to buy us out. And we were actually pretty close to the finish line at $7 a share.
And so that's the price spike. That if you look on the share price, you can just see it just kind of, it goes pretty vertical. And what happened? Why did that finish line not get crossed?
That finish line didn't get crossed because they insisted that they buy everybody else's shares except mine, which I could live with that, because the way they wanted it was I had to guarantee to work for them for 5 years. And after 5 years, they would decide whether they would buy my shares or not. So I said, look, go and ask the shareholders. If the shareholders approve the deal, I'll go along with it. But don't wait for me to recommend something where I'm going to be your slave for 5 years. So they decided not to go to ask the shareholders. So, unfortunately, it died. But anyway, such is life.
Do you see yourself as a kind of a stable revenue company, or is that not possible to do? But given the range of the way that the opportunities come and go through a cycle, I mean, should I try and value you on kind of 10 times cash flow, or 7 times earnings or something?
You know what? I'm going to say something which probably is going to be a bit weird, but I think you should value us on your gut feeling, because I don't think you can say, okay, 221 assets, one by one, are worth how much? If you put it $1 million per asset, that's a hell of a lot of money. You put $500,000 per asset, that's a hell of a lot of money, much higher than what we are now. I think you have to sort of look at the overall potential, the fact that we don't dilute our shareholders. Hey, I'm the largest shareholder. I don't want to be diluted. So we don't dilute the shareholders. We make money. There's ups and downs in the market, whether we make money, how we make money, on what we make money. But it's the overall picture of non-dilution, owning assets, no debts, revenue stream, guaranteed potential revenue at this point in time, and the past history of who we are, what we do. I mean, even if you look at our board of directors is not made up of lawyers, doctors, and dentists. It's made up of professionals. There's 3 geologists with over 40 years experience, a mining accountant, smelter accountant, and a high finance professional who's managed relatively billions of dollars. I mean, it's not Joe Blow off the street. These are serious people.
Your comment about kind of do you value it at $500,000 or $1 million, in a sense, your book value for your portfolio is probably a useful yardstick, because you said that all of them have got historic.
No, our book value is not, because I don't like, excuse my language, don't like pissing money away. So we have so many assets, and each year when you do your annual report, the auditors want to assign a value to each individual property. Well, you have to pay them to sit and argue with you about what the value of a property is. So you can imagine the nightmare of trying to evaluate 221 assets. and it's variable from things that are good exploration plays to things that have over 800,000 ounces of gold, things that are under option, things that aren't under option, things which are metals in demand, things that are not metals in demand. So it got to be hugely expensive to argue with our auditors on what value to assign on each individual property. So what we said, can we evaluate everything at 0 and just write off everything? Unlike other companies, where other companies, for example, will have a property that they spent $10 million on and got nothing, but they value it at $10 million. if we've spent 10 million on it, and if we've got something, we still value it at zero because we want to save several hundreds of thousands of dollars each year, which would have gone to the auditors. As much as I like our auditors, I don't like them enough to give them money just for the hell of it.
Interesting. Do you keep a record of the kind of the historic, the replacement spend?
Yes, absolutely. We have that.
So you've got to. Is that something you can publish? Kind of the replaceable value of the replacement cost of your assets.
Is that a replacement cost or is that money spent? Not quite the same thing.
No, they're not. They're not. And I'm just trying to think of the way to position this for investors so that they can get a handle on it. Because if you've got 220 properties, and I know that there's a whole range of from early stage to defined resources, but there's probably a quantifiable replacement cost of work on each of those assets.
Yeah, I mean, we just optioned the property out to a company called Emperor. That particular property has about, according to their calculation, over $30 million spent on it already. So do you value it at $30 million? Or do you value it at the value of the deal that we did? Or do you value it on the number of discounted gold ounces? Or do you value it at the non-discounted gold values? Hence my suggestion that you look at the totality and you value it on your gut, because it's really, I know this is not the way you're supposed to do it. I really do understand that. But we're a different kind of animal.
Before I joined this call, I spent a little while trying to find comparisons in share price performance to you by kind of pulling up your share price and then just trying different single asset producers that kind of mature gold companies, mature copper companies, mature, one by one. And there was quite a good fit between you and a mature copper company over the last 2 or 3 years.
Yeah, it could be, but we go through certain things. I mean, like our stock price right now is really low, and we got whacked in the last 5 months now. I guess 5 months, because we are deal driven, and this is sort of an oddball occurrence, but. There was a company that wanted to option one of our properties, and we negotiated for a couple months, and we couldn't reach an agreement. So they got pissed off, and I wouldn't sell the property to them. So they went into the market, they bought 4.5 million shares. And then at the next annual meeting, they voted them against us to make a statement, and it wasn't any problem. I mean, we have lots of support. And then they just sat on the stock for a number of years. And then recently they bought a number of properties and they needed to get more hard cash. So they started whacking our stock every day. And we were trading in the 150 to 160 range. They knocked us down to about 68 cents, generally in the 70 to 75 cent range. And, 4.5 million shares whacking you over months, day after day, it takes a toll on the price. And then other people become a bit fearful and you get some more whacking done. So it is what it is. So, what can I say?
Do you think they're through? Do you think they're out?
Oh, they're gone. They're gone. Yeah, they're completely gone. And there's one other guy that is hitting us at the moment. I don't know if it's for tax reasons or what, but once he's gone, I think he'll probably be gone. Well, the end of the month, the 31st, I'm hoping he'll be gone after that.
Okay, so I mean, in a sense, you're 50% down on where you'd got to. If you're half the value of where you were before this large position was being unwound, which is 8% of the company was sold in an undisciplined manner. Well, possibly to try and get back to that level, to kind of get back to $80 million, $100 million. Canadian, it's going to want you to kind of. I think the market will be looking for some catalysts in the short term. You said you're deal driven. Have you got some things in the pipeline? I mean, you obviously do, you always do, but are you confident that you'll be able to do that in the next 3-6 months?
Yeah, oh yeah, for sure. Plus, also, we're not only deal driven; we're also exploration results driven. So we have these companies that have earned their interest in the company, in the properties. We also have companies that are currently earning interest. And if you look at our press release issuances, you'll see, like this morning, we put out another press release by a company called Orford that have been drilling on one of our properties in the Joutil area. And they got like a 54 meter wide intersection over a gram gold on the known zone. And then they got another wide intersection on a new discovery horizon on the same property just to the north of it. So we've got lots and lots of news because people are working on our properties and creating value on the properties. And by creating value on the properties, they're bringing them closer to the point where either they get to production potentially, or they meet all the terms of the option agreement, which means that there are more cash payments, more share payments, and eventually a royalty and maybe an advance royalty. So it's a complex picture of trying to understand what drives the market price. And basically, it's people just have to look at it and say, you know what, company with one property is trading it and more shares than Globex has no resources, is trading at the same price as this company that has 221 assets, royalties, revenue, money in the bank, no debt, real estate. And this makes no sense. Hence the gut feeling.
Yeah, gotcha. I'm going to try, and I'm going to try another way.
Good luck.
Historic cash flows or historic revenues. Has that been off the top of your head? Has that been? I know the last 3 years with COVID and everything, and Ukraine has been particularly lumpy. But perhaps going back 5 years, have you seen some change or some growth or some stability in your cash flows?
I'd say relative stability. We have that one spike due to us selling a royalty to Electric Royalties and Sprott, and also to that deal where we sold the Francoeur Arnfield property to Yamana. But even there, I mean, it's hard. I don't want to say everything about us is hard to judge, but because of IFRS rules, the deal that we did with Yamana was for $15 million in cash payments over 5 years, guaranteed. So we received the first and the second payment, so we got another $8 million to come. But under IFRS rules, we had to incorporate the full $15 million in revenue 2 years ago, even though we only received the first $4 million, because that's what IFRS rules require. So you see in our revenue this huge spike, some of it legitimate because, well, both legitimate, but some of it actually received, I should say, because we got money from Sprott and Electric Royalties, but we only received $4 million of the $15 million from Yamana, but we had to incorporate $15 million of revenue as if we had actually received it. And not only that, we had to pay $4 million, the tax on the full $15 million, even though we hadn't received it. So now the other $11 million we received the $3 million plus the other $8 million is going to be taxed. Well, I'm saying tax free, but not tax free. We don't have to pay tax on it because we've already paid the tax on it. So even reading our financials, because of IFRS rules is difficult. And then adding on to the fact that we evaluate everything at zero makes it even more difficult.
I see it. It makes me want to go back and look at your cash flow statements on an annual basis for 5 years, just to see what the cash position, what your share position has done over 5 years, and to see whether that's got stability in it. And then that's kind of a base level, plus the fact you've got the optionality on 221 properties, plus your leverage to the to the commodity cycle, plus you're at 50% relative to where you were a couple of years ago because of the impact of selling into a soft market by a 8% shareholder.
Yeah, but for somebody to go in and look at our financials and try to understand it, for example, the ones we just submitted, it shows revenue of 2 million. Because we received the 3 million from Yamana, but it's incorporated, we received it, so it should be 2 million plus 3 million is 5 million that we received, but we had to book it 2 years ago. So you don't see it unless you go to the notes that we actually received 5 million.
That's why I would go to the cash flow statement, because I just get the kind of the cash on hand figure right at the end of the year. So it's just there's no accountancy there. It doesn't tax my poor accountancy brain. It just gives me the cash figure.
Taxes my brain. I got to tell you, it taxes my brain.
Good. So if we look at the year ahead, to me it feels as if we're at the beginning of a good time for gold. I may be wrong, but when I see this kind of macro instability and the level of indebtedness in the world and the rising interest rates, to me it feels like a good time for gold. And you've got a lot of that in your portfolio, but in a sense, the prices we can't control. But what you can control is the activity levels according to the deals you've done and the work that you're doing. So can you just talk to me about the plan for the rest of the year as far as you can describe it in terms of news flow quarter by quarter, perhaps?
I can't do it quarter by quarter because stuff just sort of arrives out of the blue. Somebody calls you up and says, have you got a lithium property? They want something, you show them a number of things, and either they make a decision yes or they make a decision no. But we have a lot of those things going on. So I can't prophesize. I'd just be lying if I told you, we're going to have this revenue and this number of deals. I can't tell you that. All I can tell you is we have a history of making deals. We have a history of making money. You look at the company, you'll see that. Whether you do it over the last 5 years or you do the last 40 years, you'll see that. And you'll see the fact that we try not to dilute our shareholders and all the rest of the things that I mentioned. I love gold. I think gold is the place to be. I think you have to. One of the other things I didn't mention is that we only work in established mining camps. We only work in democracies. We only work in rule of law. So we're limited to North America and one project in Saxony, Germany. And at the moment, that's it. Because there are very few places in the world with rule of law and democracy. It is what it is. So now we acquire these assets, and we're working principally on gold at the moment because, like you, I believe that we're coming into a gold market. I'm surprised that it hasn't taken off much more than it has currently. There seem to be headwinds. And why I really can't fathom. You look at Russia theoretically should be dumping gold in order to finance, but the reports are that they've increased their gold. Who the hell knows? We don't know. And that's one of the problems with dealing with non-democratic countries. But so we're spending of the places where we're focusing our expenditures currently are on raising the profile of gold properties, doing deals on gold properties, and acquiring more gold assets. Easier said than done, because as the price of the metals go up, a lot more people are focused on acquiring. Some of them are coming to us to acquire, and some of them are going into competition with us. So you don't exactly know what tomorrow is going to bring. All I can say is that we're doing a lot of show and tell, and we're doing a fair bit of negotiation. I can't say whether 1, 10, or 0 will come to fruition. I'd be lying to you. I'm sorry. Thank you very much for explaining it as much as you have done. I've got a much better understanding of the company now than I did half an hour ago. It's been an absolute pleasure talking to you, and good luck with the deals ahead. I mean, I'll keep an eye on the stock and just see how progress goes. Okay, and I hope you get a good gut feeling and go in the market and buy some.